Managing Director as well as VC of Mahindra Finance. Good morning. Thank you so much for joining us. So like I was pointing out, look at the numbers that we've seen in a good performance compared to the year ago period. What does it indicate? A good momentum on the back of what? Higher disbursements and improved collections?
So, overall, the demand has been pretty good. The sentiments are very positive in rural. In fact, in my previous interactions, I was asked a question on, while we say the sentiments were positive, there were some remarks received from some other quarters where the felt was that the demand is not as high. But we have seen very, very good demand, positive demand from all sectors and across geography. In fact, I would think that if better inventory levels were available, the sales could have been even much higher. Our disbursements would have been even much higher. But if I had to put it in the order of demand, all of us saw a very high demand for tractors in April, May, and therefore the quarter was very good. We saw from the vehicle side, the demand going up. Pre-owned vehicle is very buoyant. Heavy commercial vehicles have picked up. So I would think without exception, the demand seems to be there from all products and across geography.
Something else to watch out for is that while there's been a marginal increase in the cash flows, we've also seen an uptick in the gross NPAs. Why is that the case? And how exactly are you going to meet your own guidance of having gross NPAs of below 7%?
No, so let me first clarify, absolutely no stress on the collection front. If you look at our collection efficiencies, they are upward of 94% plus. And that's for the first time we see in the first quarter, these kind of collection efficiencies. It's important to understand rural in the first quarter always has a tremendous pressure from the climatic conditions, extreme summer. So the activity levels do come down. But in this quarter, what we saw, unlike ever before, is maybe because of the past lot of pending demand. The tourism was very, very high. People movement was high. Contracting segment was active. So we found that in every segment, there's been a good collection from almost every geography without exception. There were few days lost here and there because of heavy monsoons in northeast, etc. But that's not something to be really recognized at this stage. The little increase that you're talking of, if you see again historically the first quarter, normally the increase is upward of 2% plus, and that's what we had even predicted when we closed March. But surprisingly enough, because of the high activity level and excellent cash flow, we could contain it at a very, very marginal increase, and this would get corrected. To your point on how do we see going it forward, we are very confident of what we have stated, that we would bring down our gross NPA levels substantially from where we are today. And that trajectory is clearly in that direction. And the second half is the best for the rural markets. And with good monsoons, we do expect that the cash flows will hold up and we would see excellent collection and correction in the second half.
Company continues to remain the market leader as far as tractor utility space is concerned, but incremental focus will be on pre-owned vehicle. Help us understand the growth potential in this segment and how can we expect the loan mix concentration towards pre-owned going ahead.
So for us, outlook on loan mix is concerned, they would remain range bound because we are now in all segments, all geography, and therefore whatever is the overall volume of the market, we will kind of maintain or grow our market share, and therefore we don't see a big product mix change happening. There could be some marginal shift within these segments. So for us, tractor and utility vehicles and car segment is concerned, you're right, we are the market leaders in the rural market clearly. Our market shares are high and the growth rate will come from the overall volume that we see from the OEM side. The advantage I would see is apart from the volume growth for this year, we expect that there will be price increase to the assets as well, and that would add to additional disbursement. So therefore, the disbursement growth will come both from volume increase, a little of market share gain added with the price increase of the vehicles and tractors expected to be. So that's one very clear growth that is possible. The growth engines that you talked of, as I said, would remain range bound for high matured products. But the pre-owned vehicle, even pre-owned vehicle today, the availability is the biggest issue. There are not too many vehicles available because the banks and NBFCs are repossessing low because the collections are pretty good. Exchange programs are not very aggressive because the new vehicle availability is still a little issue. Once the availability of new vehicle goes up, you would see supply on pre-owned also improve. And that would definitely be our focused area for growth.
Your net interest margin in Q1 stood at 8.2 versus 7.6 in entire FY22. Looking at the current interest rate environment, where do you expect the NIMS trend to be in the medium and the short term?
So based on the increased cost of borrowing, we have already increased our lending rates to 30, 40 basis point. Is this what we're going to do every quarter? The answer is no. But clearly, if we do see the borrowing cost continue to keep moving up, then I think the market will adjust itself to the borrowing cost as well. And there would be some increase happening. We don't see a big compression of net interest margin for two reasons. One, a little pass on that will happen. Second is we talked about the product mix, and if the tractor and pre-owned vehicle numbers were to go up, they come at a much higher yield and they would help also protect the net interest margin. So from here, what would we see as net interest margin? Maybe to start with a 20 basis point dip could be seen in the next couple of quarters, but they will be the lag be catching up as we close the year.
Mr. Iyer, we're going to leave it at that. That's M&M Finance for you.